Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
Financial Survival Network is presented to you by Regal Assets. Buy and sell physical gold and silver through your existing retirement plan, 100% tax-free with Regal Assets. If you want to include physical gold or silver in your existing IRA or old 401k, request your free investment kit, which was recently featured in the Forbes and Smart Money Wall Street Journal magazines. Call toll-free 855-678-6620, 855-678-6620, or visit regalassets.com. The markets, who can pick a direction anymore? Who knows if they're going up, down, or sideways? Where we are in the cycle and what's next for gold and silver, as well as interest rates, bonds, and the stock market. So when I'm in doubt, I turn to Bob Hoye because Bob usually has the answers, and we're going to find out now. Bob, how are you?
Well, oftentimes we're reaching for answers, but I'm doing well. Particularly exciting week with a turn in Europe to, like, for example, Spanish yields rising up, because they got to 7.5, then down to 6 3/4, and then a little, maybe to 6.5, and then a little bounce up here in yield. But we want to talk about last week at Thursday, we did a piece on the dollar index, and it was in the chart that perhaps it could drift down for a few weeks, and that, of course, would liberate or continue the rally for stocks and commodities. And but instead what we had is Monday more concerns about Spain, and then Tuesday the blow up at Knight Capital, which had pushed the button on some kind of a program trading thing that about 150 stocks, as I read it, just kept getting slammed with sells. And even a junior here that I trade, I just watched it. It opened at 2.12, went up to 2.14, and then within a minute and a half, it was down to 188 and trading a huge volume on a stock that might trade 40,000 in a day.
Wow!
On 25 different trades, and by the time it was finished, it traded in two markets in New York and Toronto, over 6 million shares on, 45,000 different trades. So computer berserk, as I understand it, after the event, the night people pulled the plug on the computer after half hour or something like that, but then problem is it shorted a whole lot of stocks that they then had to buy. So my favorite little junior then rolled right up to a higher than the day before it. I think it was 215 or 216.
Wow.
So the low was 155, and I bought at 162 after the low and blew it out near the $2 level. So it was a good trade. But it just this one doesn't reveal that there's no liquidity in some of these stocks, because it happened to some big stocks and they held the trading on them. But let's just look at it, Kerry. You have a financial company did something stupid after the event. They may be facing insolvency. They're talking about raising money. But I just look at it as at the top of any speculative market, there's always the first financial company or bank or something to get into trouble. So we don't know how serious the trouble is, but it's an event. So let's say it's a heads-up event whereby you've got a speculative condition in the markets and something goes wrong. Small at this stage, but who knows? So let's look for some relief in stocks and commodities over the next few weeks, and let's also keep in mind that after August, you get into the season where if things are going to go wrong, they will go wrong in the fall. So, and on the fund side, on the corporate bond market, you had the LQD, which is an ETF for investment grade corporates, and it rallied up terrifically, and it's still going. But 2 weeks ago, it gave what we call an upside exhaustion on our proprietary model. And when it gives that in previous highs, the high can come in a few weeks later. So we're a few weeks later. The other one, there was an up channel on a line on the chart that gave us a price target of 122, and the high today was 121. So, and as we technicians like to reveal, that when you draw a channel line on the chart or a trend line, the precision, it depends on how thick you drew the line. So anyways, the advice here is that the target has been essentially obtained. We're in a condition of upside enthusiasm, so on the corporate bond market, it's time to start lightening up for fund managers. But this follows a similar overbought upside exhaustion for the long treasury. That was for 10 years of the 20-year bond back in May. And that one was zoomed up so nicely that we called it the Eiffel Tower pattern. It's made the up at the 150s level, and it's been trading up and down sort of sideways to a new high recently. But the technicals are there and the sentiment was there, so that you can probably have the downside, and let's call that the downside of the Eiffel Tower. That is coming ahead of us. And then more recently this week, we're looked at an emerging market bond ETF, JP Morgan's one, it's EMB, and it has been in party time as well. And the pitch by those who are marketing is that not only are these emerging countries improving, but also there's a developing middle class, and they then are becoming savers and investors and will buy these things. But hey, what it really is compulsive buying, as investors are forced to reach for yield, because you look at these ridiculously low yields on Government of Canada bonds or U.S. Treasuries or the gilts in London. And so they're being forced to reach for yield, and that's not a healthy sign. It's a sign of ending action. And this EMB is up given a technical signal. Overbought, yes, but you also have that overbought thing we use is the RSI. And it had a really good surge up in the RSI until a week and a half ago, then it corrected back. And then now, although the index is making new highs, slightly higher, the RSI is not as high. So that's a negative divergence. And we've seen that at important highs over the last 5 years. So here again, another bond series saying, watch out. So now then the next thing you might wonder is if bond prices are going to sell down harshly, some people would think that maybe commodities are going to go to the moon. But I don't think so. I think the bond market has been an asset play itself, and it doesn't matter what's going on elsewhere. And it's up and concluding technical action that says at the top. So I think it could, if the bond market fails, it'll have repercussions, and and it could be nasty. And at the same time, you could be having liquidity problems in commodities. The base metals have firmed up since last fall quite a bit, but and that sort of peaked in March, and then they've been backing off since. Then the one thing that helped bring the CRB commodity index out of its problem was, of course, this huge rally in the grains with the drought. Now, essentially, the soybeans, corn, and wheat are up to previous highs. They've got really good momentum, and everybody knows there's a drought and the corn crop is severely damaged. But perhaps, and we're not going to call these moves from week to week, the best is in for on the drought. The damage is being assessed, but what the grains have to face is probably problems in the fall. I think the global economy is slowing quickly. And then if you have a crisis this fall, they'll commodity prices will go down too. So now, admittedly, that's not a terribly pretty picture, but I think it's a fair assessment in what makes it practical is that these overbought and technical measures we have, you've got readings only seen at previous important highs. So it kind of takes the emotions of the observer or the writer out of the equation, and all we do then is observe, hey, this is a speculative market, and you've got a slowing global economy, and you've had a financial accident with a small financial firm. So we'll watch and see what happens next on that one.
Yeah, so you're thinking if something bad is going to happen, fall is the time when it happens. And that was kind of my feeling. I was thinking we're getting through the summer here. We're already halfway through it, and not a lot is happening. The market's trending higher, but getting kind of listless. Yeah. And now we're getting to the fall, and that's almost always the time when bad things happen, right?
Well, you've got the old saying, sell in May and go away. And but historically, wherever there's been 2007 was the peak of a great financial bubble. The previous one was 1929. The one before that was 1873.
73, yep.
And they go back and...
I remember it well.
The first one was the South Sea bubble of 1720. And although that's 300 years ago, it's crowds in action, and there are great similarities. So each of those, now here's...
Well, nothing changes. Course, it's human nature, right?
Crash. Yeah, you had the crash in 08, which was worst in the fall. Mm-hmm. So here you go. Now, each of the 5 previous bubbles crashed in the fall. And when the U.S. market became bigger, like in 1873 bubble, Europe peaked in, here we are, Kerry, May or June. Mm-hmm. And then the New York market had a tendency to hold it all together until September and then fail. So you had the fall crash globally in the fall of 1873. Same thing in 1929. European and British markets peaked in May of that year. And that the New York market managed to hold itself together and make a high in September, and then the crash. So, and even then, going way back, the only thing I found really early about financial disasters was in northern Italy in the 1340s, which was then the financial center of the world. And they had a big mortgage market there, and it crashed, and it took about 3 years before the disaster was finally over. But in a very authoritative book on it, I think his name is Cipolla, right. The worst parts of that disaster occurred in the fall. So then we also know that there were collapses of mortgage markets in ancient Rome. But I haven't seen anything to date that would give you the time of year when it happened. So, but we know from history, 700 years of it, that bad things can happen in the fall. So let's be prepared.
So if you're preparing, if you think, and because things are topping and the market condition really is kind of weak anyway, the underlying economy, what do you do to prepare? You pair your stock holdings?
Yeah, where you've had some winners, you start taking the money off the table, and you say to yourself, okay, hopefully we get another rally. So the advice since the beginning of the year was to sell the rallies. And we thought that the big one would end centered around March, and it essentially did. So then now we're selling each rally, and you say, okay, I've got this much I want to take out of the market, and hopefully we get a few rallies here towards the end of August, and I'm going to have my selling program completed by then. And then you wait for the turn to come in, and there's plenty of ETFs now where you can get short without a huge amount of risk. There's one that we kind of like. It's HDGE, and this is an actively managed short fund. And we checked back over 9 months of what they were trading, and gosh, they were very good at picking individual stocks to really hit on the shorts. And so I considered it my investment grade short position. The rest are trading positions. So
that makes a lot of sense.
So there are tools, whereas 30 years ago, most of the retail accounts, the brokers would encourage you to stay in or buy defensive stocks because they go down slower. And it was very difficult for investors to get out of the market, let alone get short. That's to many a daunting appeal, but a daunting item. But then if you've got an ETF that is a short, at least it goes up when everything else is going down in price. So for those who can be calm and cool about it and fairly nimble in trading, we would be selling, lightening up successful positions and into late August, and then at some technical point entertain using some of these bear ETFs.
Yeah, it sounds like a good idea, and you think that cash is going to be the place to be then, effectively. If you can't go short, be in cash, huh? Yeah. And also we're looking at, like commodities. You had the cyclical high in 2008, and they crashed, went from 470 down to 200 on the CRB.
I remember. And then you had, when the panic ended in 2009, just a minute, I'm going to bring up the CRB here now. Yeah, that was from 473 down in 2008 down to 200 as the panic ended in 2009. Mm-hmm. Then when the panic ended, you had a business cycle come in and rise up until fairly recently. And then you had commodities, the CRB set another high, really good momentum and everything else at 370 in April last year. Now that one for us was a technical success because we have an indicator called a momentum peak forecaster. Sounds like a long term, but
sounds very complicated.
It does forecast the likelihood of when you're going to get a momentum peak, and it doesn't come in too often, but when it does, it works. So this thing registered in January, and when that registers, usually the high is about 2 to 3 months later. Like you're looking for a speculative surge, and at the same time you're looking for it to end 2 or 3 months later, and it did end in April. And that one, when commodities are involved and gold and silver are very much in the play, like this thing came in big time in 2 months before the high for gold and silver in January of 1980.
Part 2 is available to subscribers of FinancialSurvivalNetwork.com. Go there now, sign up, and enjoy.